Welcome, everybody. We are live here from San Francisco and Tampa, Florida. Thank you, everybody, for being here with us today. If someone doesn't mind just saying hello in the chat box, make sure we're broadcasting okay. That would be awesome. So welcome, everybody. And it's been a pretty interesting, thank you, Doug and Mike, interesting time with the webinars and a little bit of Zoom fatigue with everybody, but we've been enjoying 2 or 3 of Family Office Insights webinars and meeting interesting opportunities. And once again, I'd like to thank David Siegel for kindly introducing me to our guest today. This will be the second version of talking with Right Side Capital and Jeff Pomeranz. I can say backed by popular demand, let's just say that. We have quite a big attendee list today. However, we will do our very best to answer as many questions as we can, and please feel free to ask them along the way. A little Zoom housekeeping, please, as I said, you can ask questions in 2 places, in the chat box and the Q&A, and we will be monitoring that closely. This is being recorded, so for whatever reason you want to review it or share it with others that might benefit from viewing it and connecting with Jeff, super appreciate it. And then you're welcome to see it in a day or so on the Family Office Insights YouTube channel. Just to be super clear, our objective here today is to make you aware of Right Side Capital Fund and be potential investors for you or those of you that could benefit and others that you know that could benefit from being an investor in the fund. So with that, I'm going to hand it off to Jeff, and here we go. Welcome, everybody, and thank you.
Thank you, Arthur. Thanks, everyone, for joining. My name's Jeff Pomeranz. I'm a managing director at Right Side Capital Management here in San Francisco. And we are one of the most active pre-VC stage tech investors here in North America. We got started in 2010. We launched our first fund in 2012. We now manage 5 funds, about 100 million in AUM. And we're currently raising our Fund 4, which is what we'll talk about here today mostly. And I'll go through our strategy. I'll go through our history and performance, all that kind of stuff. But first, I'm going to talk a bit about the segment of the market that we take advantage of, how it evolved, and some of the big trends that have, since we started and even over the past decades, that led to this opportunity. So let me pause for a minute. I'm going to put us on screen share here. Hold on. Okay, everyone see okay there?
Yep, it's perfect.
Okay, so first of all, just to establish what we're trying to accomplish, what our goals are with all of our funds. And this is what we think of as our core strategy. We actually have 2 different strategies we operate. This is the 4th fund of our core strategy. What we're trying to deliver to all of our LPs on a consistent basis is get venture-like returns, 3 to 5x net multiple returns with substantially less risk than traditional venture capital. We want to not just get these returns, but do it repeatably, do it consistently, fund over fund, while mitigating the downside and having a lot less volatility within those funds. And thirdly, we optimize for tax efficiency within the strategy. I'll talk more about that later, but there are a couple IRS rules that are there to incent early investors like ourselves, angels, and so forth, that we can take advantage of that leads to us having most of our gains actually free from all federal taxes. So in aggregate, actually, we think our funds, and this has been happening so far, will have something close to a 0% federal tax liability. And in 45 of 50 states, which conform to the same rules. And I'll go into a little bit more of that later. So let me first touch on a couple of the trends, and there's a couple big ones that have gone on for decades now. They're not new, but they have hit some inflection points more recently that have led to these opportunities and some disruption in the tech funding market. So the most important one that's applicable for us is the capital efficiency trend within technology. So this is just the concept of what it could, and this is specific to software in general, okay? It's that the cost to build software product has plummeted over the decades. I'm sure we can all remember back to the .com days, the 90s, when it took tens of millions of dollars often to build product and to get a product launched and to get initial customer traction. So that's gone down every year with things like open source software, and data storage is a great example, which used to be extremely expensive for companies to operate with server rooms and so forth. Now is a line item expense with Amazon Web Services and such. So those costs have plummeted. And now in the 80s, 90s, early 2000s, the venture industry as a whole addressed these needs quite well. Large amounts of capital needed to get tech product launched. Now in 2010 was what we look at as really the first inflection point with that happened in this capital efficiency trend, because by 2010, instead of companies needing tens of millions of dollars, it had evolved to a point where they really only needed $2 or $3 or $4 million to do the same thing. And one of the other trends that was happening at the time was the ballooning of assets within the venture capital industry. So at the same time costs were plummeting, you actually had the average check sizes that venture firms wanted to be writing had more than doubled in size. So you had a divergence there, and that created what we now look at as the micro VC market, the prevalence of seed stage venture funds, which there's been something in the range of 5,000 to 7,000 new venture seed stage and pre-seed stage venture funds created just list on Crunchbase alone in the past 7 to 10 years. So pretty amazing. Now, if you fast forward, continuing from 2010, again, the trend just continues. And a bit surprisingly, those costs have gotten to such low amounts that companies today, and by 2016, we really look at that as the next major inflection point where we started to see companies that were coming to us for first outside capital now having actual live products already launched, having some customers, having some revenue that literally had never raised a single dime. They'd bootstrapped themselves to a live product, which is pretty amazing. So they're looking for just these small tranches of money, $200,000, $300,000, $400,000. That's all they really need at this point in their life, because while they might have a live product, they might have some initial customers, they might have $10,000 or $20,000 or $30,000 of monthly revenue. They by no means have figured everything out yet. Everything from, what their ideal, customer might be, or their sales model, all sorts of things. So they're not ready to raise a couple $1 million yet. They're not ready to hire a sales force yet. They're not ready to raise a few $1 million. And why this is significant is this amount of capital is simply too small in general for the venture industry to bother dealing with. The economics of a $200 or $400 million venture fund simply doesn't lend itself to bother dealing with vetting companies and spending lots of man hours on companies only looking for $300,000. So that led to really what amounts to a supply and demand imbalance. And But let me talk a little bit about the dynamics as a whole within this, what I refer to as a pre-VC market. And I'm defining here this whole stage as what we now call, I mean, we used to call it pre-seed stage, but that's come to mean something later than what we do. So we now call it pre-VC stage. So what these companies look like are companies looking for $100,000 to $400,000. They have a live product most times, and that demand is increasing every year from companies like this, because there's more and more companies out there that are looking for these small tranches. Because the venture industry can't really address it well, there's been no really new body of professional investors step in to fill that void. So you have a huge demand and no new supply essentially addressing that demand. That leads to this huge imbalance where we can exploit by having no professional competition, getting better terms, lower valuations, things like that. So before I get to how we go about doing all this, just to reiterate, what our strategy is doing, it's exclusively targeting this pre-VC stage of the ecosystem, where the round sizes are too small for the bulk of the venture industry. We're exploiting all these inefficiencies to generate consistently, high returns with relatively low risk, and we're optimizing for the tax efficiency at a fund level. So our solution on how to address this, because there's some big problems and challenges within this industry, the segment of the market, is we developed our own data-driven investment process. Think of it as a largely quantitative approach to tech startup investing, where we're utilizing the objective data on a company as opposed to subjective gut feel and opinion to inform us of better profiles of companies within the large pool of companies as a whole. Companies that will then have greater odds of success, greater survivability, greater ability to cater towards where the exits are, et cetera. We then can also deliver by having a quantitative process, it allows us to move very, very rapidly. And it's critical for two reasons, but one of which is that it allows us to provide a product to the entrepreneurial community that wasn't previously there. It's a very fast, transparent funding process, and where we're giving the founders decisions, a yes or no, usually within days, and we're able to fund these companies usually within several weeks of time. Now that can compare that to what is the normal process for startups, which is often going through a 4 to 6 month, highly distracting fundraising process that often leads to lots of, keep me posted and getting strung along. Whereas we don't. We're transparent and we operate very quickly. Most of the time it's a no, obviously, but we're giving these people a no immediately. And secondly, it allows us to build highly diversified portfolios, funds. So our funds can now have exposure to many hundreds of companies within it. Our funds, our last couple of funds each had over 600 companies in it. The fund 4 that we are currently investing out of today already has 160 or 70 companies. By the time we're done investing, we'll have 600 to 800 companies in it. And what this does, and I'll get to more of the details on what that does for a return profile, but that basically has the dual effect of locking in the high returns that exist within this segment of the market and protecting the downside. Let me pause for a moment to touch on the tax efficiency stuff, and I'm not going to go into detail here, There's a lot of nuances and details to how this works. I'm not a tax person. We just take advantage of these rules and we hire the professionals to assist us along the way. But I'll touch on the two big ones here. The first rule that we take advantage of is it's called IRS Rule 1202. And that's often referred to as Qualified Small Business Stock Rule, QSBS for short. And what this allows for qualifying events is for the gains on those qualifying events, an acquisition or whatever, a sale of that stock, to be free from federal taxes. The limits are up to $10 million of gains or 10x your capital basis, whichever is greater. The big qualifiers, and again, there's a lot of nuances here, but the big qualifiers are you have to be invested very early. It has to be original issue in stock. You can't buy it from somebody else. And you have to have held it for at least 5 years as equity before that qualifying event. And it happens that, everything we're doing, basically, or most of what we're doing, certainly, fits within those parameters. Most of our larger gains are going to be on companies we've been involved in for more than 5 years. The second rule, which also plays a part, is Rule 1244. And this has to do with how losses are treated. And and these rules, by the way, they're not new. They've been around for a long time, and they're basically there to incent early, high risk dollars to go into the angel market and startups for job creation. But Rule 1244 addresses how losses are treated, and for qualifying events there, losses can be taken against income and ordinary gains as opposed to just capital gains. So you get to use it to greater effect. Let me touch on here, I'm going to go into the performance, but at a high level, the result of our strategy on a profile of returns is we're now able to deliver, again, because of this huge diversification within a really high performing segment of the market, we're now able to deliver consistent high returns still, knowingly sacrificing the massive home run win at a fund level. We'll have companies that have massive wins, but at a fund level, we sacrifice the 8x plus kind of home run in exchange for protecting the downside, like I mentioned. This equates to like a 20% IRR, give or take again, obviously higher on a taxable equivalent basis, and very low volatility along the way. So I'll touch on Fund 1 here because it's 9 years along now, in the last couple of years of its life. We launched it in 2012. We have exposure to 279 companies within that fund. We invested over a 3-year period of time. It's at 3.65 net TVPI, so that's like it's up 365%. We've distributed now through Q4 159% of investors paid in capital, including January. It's actually up to now having distributed 176% of paid in capital. That's an IRR of 19%. And clearly now we're set up to be, by the time we wind it down in another couple of years, it'll be a, 4 to 5x net multiple, something in there very easily. So from the goals that we set out for, it's obviously on the very high end of things. All our LPs are very, happy with the returns there. For I'll touch on what's happened now because we have real data here on the tax treatment. And this is what you see in the lower right is the actual, this is taken from a $1 million LP from our first fund through Q3. Q4 has not been finalized yet. But for a $1 million investor, through Q3, they've received $1.2 million, a little over $1.2 million in distributions out of the fund. Most of that, 92% of that has qualified for QSBS exemption. And when you combine it with how the losses pass through, because while maybe most gains will qualify, but all losses in some form qualify. They've actually, our LPs have actually received what's in effect a tax credit. So there's $131,000 of extra tax losses is ultimately passed through that they can take advantage of.
So Jeff,
Yep.
can you jump back to that slide for 1 second?
Yep.
First, I think I'm going to help you here, and because there's detailed questions about the tax, and I'm just going to say for Jeff that we really can't answer the detailed questions about the tax, because not only is it consume time, but it's really something you should consult with your own folks. So there's a couple detailed questions that have been posed. So and the person that asked that, forgive us, but we're not going to answer those questions for now. There is some more detail available following this, and you can obviously do your own research. But back to this page, what really matters is what the IRR is, right? However, if you could give us a sense of, how many of these did you have to flush of the 279, for example?
Got it. So let me touch on a couple of things. So one, to reiterate, Arthur, thanks for clarifying that. Yes, I mean, this is extremely nuanced tax rules that obviously we don't have the time to get into, nor do I have the expertise to go into those kind of details. So we don't want to come off in that regard. Most importantly, whether you're an angel investor investing in a venture fund like ours, whether you're a founder, the most important thing is simply to be able to bring this stuff up to your tax person and make sure they know these rules intimately. Anybody that wants some more detail, I'm happy to forward our deck, which has an appendix that goes into quite a bit of detail here, and we're happy to have more dialogue on it. To your question, Arthur, on a little bit more detail on our first fund here. So yes, and again, for anyone who's interested, we can provide all the stats and survival data, all this kind of stuff. So we went into the strategy with the presumption that obviously most startups fail, and we modeled it on the assumption that roughly 2/3 of the companies are going to fail, and failure usually means you're losing most, if not all, your money at this level. That's the industry average. It's been that way for decades. Now, we obviously do a lot of things to increase survivability, and that's played out quite well. We're 9 years into our first fund, and we've had I think 59 exits out of those of companies that have produced positive returns for us. And we still have something around, I think it's 115 companies still operational today. Now, so we actually have about 60 to 65% of our companies now have either exited with some positive gain for us or are still operational within the fund. Now, that doesn't paint the whole picture. Again, it's more details here I'll be happy to go into offline with people that are interested. But ultimately, remember, all venture capital is predicated, these are skewed return curves. It's a smaller percentage of the companies that represent the bulk of liquidity. And that's no different for us. We just have more companies. So instead of 1 or 2 or 3 companies in a traditional venture fund that produce all the returns, we're going to have a dozen, 15 or 20 companies. So it spreads it out. And that's the case here with our fund. So the top dozen or so companies within our fund have produced and are still maintaining the bulk of the value that remains in the fund. So hopefully that provides a little bit of context without going into all the details here.
Yep, that's good. Thank you.
Yep. Just to touch on, there's a couple things that I'll touch on here that go into some of the returns of our second and third fund. So this chart shows historical quarterly net TVPI, that's the net multiple on our fund, every quarter since its launch. So the blue, being 9 years in, is obviously our first fund. The orange is our second fund. The green one at 3.5 years old is Fund 3. Now, a couple things to point out here. It's easy to see that all the funds pretty much do the same kind of thing, follows the same kind of profile. There's not a whole lot of volatility, big ups and downs. That's important to us. What's also starting to show is how, because of that capital efficiency trend, things have actually gotten better since we started. This is why you see the green line, Fund 3, clearly well ahead of the prior two funds. What Fund 3 has been able to do, having launched in 2017, and remember, that's post the inflection point in 2016 I mentioned before, we've essentially been able to invest in companies that are further along in their life, have more traction, more revenue, but we have not had to pay any higher in valuation because of a continued lack of professional dollars being deployed there. Another way to look at it is, Fund 1 was largely pre-revenue companies that we invested in, because back in 2012, companies, when they were looking for first outside capital, generally needed a chunk of capital in a year or more time to get a product built still. By 2016, 17, that simply wasn't the case anymore. They already were live with the product, and therefore we weren't taking the risks of a company running out of capital before they were even able to get a product launched, or launching a product that no one cared about or no one was willing to pay for. So less risk for the same price is another way to look at it. And that's obviously resulted in our later funds actually on a track to outperform earlier funds, even though our first fund is doing extremely well. I won't go, these are just some highlighted, some of our biggest exits to date. A couple of things just to note here is by combining some of these factors of being invested extremely early at very low valuations, 90% of what we do is invested at valuations of $1 to $3 million. So combine that with capital efficiency, which also leads to less dilution in many cases, we can get, very, very high returns. Obviously, some of the top ones there are returns with companies, looking at 100x plus returns, but we can often get those returns on companies that aren't so-called unicorns. That top company, which we've sold part of our position in, we sold half of our position. That's a company well under $1 billion in valuation when we sold half of our position. And so the idea here is we can get massive returns in sub-billion dollar valuations, and we can get very high returns, 10, 20, 30x returns, where the bulk of tech exits will lie, which is in the sub-100, especially sub-$200 million exits. And that's critical because that's what fuels the bulk of liquidity. Just to touch briefly on the three of us as partners, the team, we've now been working together 10 years or more, 10, almost 12 years. All of us are startup guys. My two partners are tech entrepreneurs from the Valley. They went to Stanford together. That's how they knew each other in the late 80s, early 90s. They both had a number of startups each in the Bay Area here. I come from the financial services side of the industry. I got started in the wealth management side at Smith Barney. My first startup was a brokerage firm that we built it as a technology research boutique, and had investment banking and other activity there for a number of years. And so we come from very different sides of the industry. Again, the details are all in the deck that I'll be happy to share. Let me close with a couple comments about the environment we're in today and what's now sort of a post-COVID world, and some form of a bit of a recessionary environment in some capacity. Disruption is good for startups, is something to remember. It's good for venture capital as a whole. It shakes things up. It creates opportunity. And when you're smaller and more nimble, you can attack the larger and more embedded competitors more easily. And historically, any kind of recessionary environment's always been some of the best vintage years, just because it's a better operating environment. Dollars go further, talent frees up, and so we look at today. Certainly, since we began in investing in 2012, it's clearly the best macro environment we've ever had to be investing into. And we feel that our Fund 4 now is set up from an expected return standpoint to potentially have to outperform all of our prior funds. So I'll pause there, and we can jump into. Oh, actually, let me just clarify again. So our Fund 4 now, again, you can see all the details here. We have a standard sort of venture capital template structure. So it's a 2% management fee, 20% carry. We have still a cumulative preferred return for LPs, so they get a 5% cumulative preferred return distributed prior to us taking any of our carry. But otherwise, it's a standard kind of venture capital LP structure.
So a couple of questions. There's some structure issues that are prerequisites for you to invest, and the standard safe agreement, that sort of thing, I don't think works. There's a question about how you what's the structure need to look like for you to be able to invest in a company. Let me just read the question. Are there preferred instruments for pre-VC investing? Are we using convertible notes, safes, preferred equity?
Okay, so any of those forms are actually fine. It's evolved over the years. When we started, actually, we did quite a bit right away as preferred equity rounds, and we created a very cost-effective way of doing so. It then moved towards convertible notes, and actually in the past few years, the industry, and this isn't just us, the whole industry has moved towards using safes, simple agreement for equity. So any of those are fine, but most of the time now we use safes as the investing at investment time. Ultimately, whether it's a safe or convertible note, ultimately we end up owning preferred equity shares at conversion anyway. That ultimately is where we end up as a result.
Great. We have another question. Thank you, Jeff. Can we please expand on the capital efficiency concept? I understand how that equates to less dilution, but can we dig in a bit more as to how your data-driven approach pre-identifies capital needs?
Sure. So first of all, so this is relevant only. So when we talk about capital efficiency, we're looking at, how much capital does a company need to get to their next milestones, what their burn rate is, how much do they need to get to a meaningfully cash flow positive state to have validated their business model. So most of that, it ends up looking like software, although not 100% of the time. So things like materials, science, R&D projects, life sciences, hardware is still very, more cost intensive. Anything with manufacturing of a physical product tends to not work for us. It's no commentary on it being a good or bad business. It just doesn't fit the capital efficient criteria that we're looking for, and that we can take advantage of. So when we look at companies and the data we're looking at, and again, I'll talk in generalities here for the sake of time, we're looking at these factors of how much capital have they raised to date to get to the point they're at today? What is their burn rate today? And another way to look at it is, all things being equal, if we're looking at two identical companies, identical founding teams, identical segment of the market they're going after, they're both doing $20,000 of monthly, SaaS revenue on a high price point, $4,000 a month product or something. We would rather have a company that's only burning $20,000 a month than a company burning $70,000 a month. The success of that company, that product, it has so much randomness and unpredictability to it for 5 years down the line. But if we have greater capital efficiency, that increases survivability, it increases their runway, and that extends the time they have to figure things out and adapt and change and pivot and so forth. So if that helps give you some guidance on what we mean by capital efficiency.
Yep, I think so. I don't mean to spring this on you, and we didn't plan to do this, everybody. But what I found was super instructive about your process. And I would argue that you also benefited from the decreased cost of building software with your process that you built, right?
Right.
And so when I look at your website as a potential entrepreneur, for example, and see your application process, you've managed to tell people right up front, this isn't going to work, 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 and here's the application. I don't know if you want to show that, but I think it's super instructive. But you can do that if you want, but let's answer a couple more questions. What's the minimum check size to invest?
So for limited partners coming into our fund today, we're fairly flexible, but 250,000 is the minimum commitment. It's a capital call basis over about 2.5 years. They're coming in with an initial capital call of 40% right now, and the balance over the next 2 years.
Excellent. And are there any geographic limits to your investment considerations or investors?
Well, there's no limitations for investors. LPs coming into our fund, we have, most of our LPs are US. That's certainly not entirely the case. We have plenty in Europe, Southeast Asia, Australia, and other countries as well. For our investments, we focus on North America, mostly the US. We're fine with Canada as well. About 90% of what we do are US based companies, and but we do want US C corps. So there is a small 5 to 10% of companies that often they might be from outside the US. They come to the US to participate in an accelerator program. They establish a US C corp. We find them through these kind of channels. We're fine investing in those, but they might be technically French or wherever, and maintain a US C corp, and often will actually still maintain a US presence as well. But a lot of times their engineering teams and so forth will be elsewhere. We're fine with that. But for the most part, people should think of this as a US focused, certainly North America focused fund.
Great. So how far along, if you're willing to say, are you in the raise?
So yeah, we'll be going through a final close in April. So we're most of the way through. We'll be wrapping it up in the next 2 months.
Great. So there's a pretty traditional question also, you can choose to answer it or not, but of the prior fund LPs, have they voted with their checkbook on this fund?
Yeah, so like you would expect, we're no different there. Most of our LPs from earlier funds re-up in subsequent funds, and That's always been the case across all of our funds.
And have you found your theme, aside from your narrowing the market and uh, investing in companies that don't have high burn rates as it relates to building technology, have you found that to come true actually? I mean, you'd see it in your performance, but is it really costing people a lot less and continuing to cost them less to build apps, to build technology, to build,
Yeah,
is it
that part of it is definitely the case. Product is cheap to build. Now, scaling is still expensive. Hiring teams of people is still expensive. So, you know, we're not, and we have plenty of companies that have raised huge amounts of money. And, you know, one of our, you know, I think our biggest a company from a capital raising standpoint has raised over $700 million. So now it's a $3 billion company now, and we've been diluted along the way quite extensively, but we own a smaller piece of a $3 billion company. That's fine. The math all works.
not entirely a bad thing?
Yeah, but to your point, the capital efficiency is on that's the product side, and what that does, among other many things, is it sets up what we want are companies that it's more of a choice or an option of what path those companies take. They don't have to take the venture capital path of funding. They can choose to take alternate paths of funding, and they can choose to keep in play lower value exits. In other words, they can raise, having raised only a couple $1 million, they can appeal, and things haven't gone well, obviously, they can appeal towards a $100 million exit, $150 million exit, where that's not the path of traditional venture capital. And that's important because 3/4 of all tech exits are in that space. They're companies that are actually, these are small, even really sub $50 million exits. We want to be able to produce very high 10x plus returns in that market, in that exit market. And it's no surprise, I'm getting a little bit off on tangents, but it's no surprise that it's a similar stat of the fact that 3/4 again, roughly, of all of these tech exits are actually companies that never have taken any institutional or venture capital, because there's a divergence here. And again, it's not a commentary on venture capital being bad or something, it's just a different path. And because the average traditional venture fund is not looking for a 75 or $150 million exit, because that's not going to move the needle enough on their $400 million venture fund or $1 billion venture fund. They need those to be very, very large, you know, multiple hundreds of millions of dollars or $1 billion exits. And there just aren't that many of them.
I think it's a super interesting and relevant nuance that isn't as obvious, because not everybody recognizes that the traditional venture needs to pour a lot of fuel on the fire and want that big unicorn exit to offset all the money they poured in the ones that they put $3 or $4 or $5 million in, and they only exited it, you know, $1 million. So they took a hit and a loss, right? So
Yep.
I think it's a very thoughtful nuance. We have what's the total fund size, Jeff?
So across our funds, we manage about 100 million in assets right now. This fund 4, looks to be it'll be somewhere around a $30 to $40 million fund, is where we think it'll fall.
Great. And in the spirit of a trend of, I guess this question is meant this way, of, you know, low or no friction co-investing, do you ever redistribute successful company shares rather than make the sell decision yourselves and give LPs the choice of riding them for longer?
Yeah, so two things there on giving LPs the choice to receive shares in kind or not is sort of uh, um, it's a decision at the end of cycle of a fund's life that's more pertinent than earlier in a fund's life. We don't have a problem with that for those companies where it might be pertinent. We're happy to accommodate LPs that might want that. Reality is most don't. And remember, when you have funds with hundreds of positions, even our biggest exits, these aren't massive, broken out by most LPs. I'll put it this way: most LPs don't want a handful of shares of some position. It's more hassle than it's worth. Now, the other part of what you brought up, though, is pertinent of like co-investment and things like that. We do for those. We have a body of our LPs that are also very active angels or later stage investors, and we're happy to assist them and provide relevant opportunities from our huge evolving portfolio of tech companies, and we're happy to do so. So we have a group of our LPs are very active with us every month. They're investing in companies from our portfolios at later stages.
Yeah, super cool. Yeah. And sans any friction from you. And I mean that in the most polite.
Yeah, well, we're quite the opposite. We're the ones greasing the wheels, right?
Yeah.
We're providing the introduction, and helping get them, into a meaningful relationship with those founders. It often, remember, it can get very competitive at later venture stages. So that relationship is critical. It's not competitive at the very earliest stage. It's the opposite, that founders are struggling to find anyone that is willing to write small checks. That's tough. But once you get to later stages, it can get very, very competitive, and that introduction can get is very important.
So this is from our good friend Hamlet, who everybody should know, including you, Jeff. Hamlet Yosef, what is the sourcing of your proprietary deal flow? Do you tag along with other Silicon VCs? We talked a little bit about my editorial. We talked a little bit about your application process, which is pretty cool. You want to talk about deal sourcing?
Sure. So no, we don't tag along with other Silicon Valley VCs, because they're by nature generally all later than us. So we share our existing portfolio companies that are raising later rounds with those so-called Silicon Valley, any VCs, not just Silicon Valley, but because in general they're interested in companies now raising $1, $2, $3 million and greater. So we're not, they're not co-investors with us at our first check. They're coming in later. So the deal flow, I'll divide it in a couple buckets, but we obviously have a massive front end of the funnel, and categorically, number one, we're getting a huge amount of deal flow from our, referred to us from our existing founders that we have touched. We've now invested in, have exposure to over 1,100 portfolio companies over the years. That's 2,000 to 3,000 founders across the US and every startup community out there. So they're referring their friends, peers, colleagues, other people in that work share space or now virtual workspace space, et cetera. Secondly, we've built and invested heavily in building relationships with the accelerator community. Now, accelerators have exploded onto the scene for all the same reasons, that I've mentioned in this capital efficiency thing. 10 years ago when we started, there weren't that many accelerators. Now there are thousands. And we have many significant relationships with them that they're funneling appropriate companies to us on a regular basis. We've partnered with a good number of them. We have created some interesting creative structures to invest in cohorts of companies. We've even taken ownership stakes in some accelerators. So that's a natural synergy because of the segment of the market overlaps. And thirdly, because we've now been around 10 years and have done the numbers we have, any founder doing their job can find us pretty easily. So there's this massive exponential increase in just cold outreach to us. What's important is, yes, we have this gigantic front end of the funnel with many thousands of companies coming into us every year. What's critical is to be able to filter that stuff appropriately and efficiently. And that's where we have, one of the many. So we have a number of, Arthur, you referenced this already. We have a number of tools and processes we have built, a tech backbone ourselves, that assist us at every level of our process, from the front end filtering to, in what you referenced as a sort of an application format of data that we take in from those founders, to the very back end portfolio management. Think of it like a database ultimately that houses all of the ongoing business updates and data we receive on a regular basis from all our portfolio companies. That resides in the database so that we can identify problems more rapidly. We can identify opportunities rapidly, and we can help those companies in ways that can both be beneficial to individual companies and the portfolio as a whole.
Yeah. So how do you view the crowdfunding business in terms of competition, if at all?
It doesn't really come up much in reality. We come across it occasionally. We have companies that have raised capital on crowdfunding platforms. Usually it's our existing companies that we've already been invested in that raise some additional capital on a crowdfunding platform. I'd say it's an extremely small percentage of companies. So it's very difficult for a raw startup to be able to get any traction or attention on any kind of crowdfunding platform. So crowdfunding platforms tend to be a little bit later than when we are getting involved. So no, it's not. We don't look at it as competition because they're at a different stage. And also, just from a volume standpoint, there's not much dollars actually being allocated to companies through crowdfunding platforms. They exist, they're out there. I think it's great. They're a participant in democratizing access and things like that, which is I'm all in favor of, but it hasn't really hit any major impact in the industry like I think a lot of people had hoped would happen or thought would happen.
Yep. Excellent. What would you invest in a company that doesn't fall within the QSBS guidelines?
Well, okay. So when we invest in a company, most of the so the guidelines are about what qualifies at exit, and that's an unknown circumstance years down the road. So it's a little bit more of a complicated question than you might realize. So yes, we do invest in companies that at the outset we know actually they might not qualify. For instance, we do invest in, I think 5% of what we do is in Canadian companies. Those will not qualify. Okay. Now everything else is a US C Corp, and by nature at our entry point, it already qualifies because it's a US C Corp and we're invested early enough. What we don't know is if at exit we've held it 5 years or not. It might have a huge early exit, and that won't qualify. But we're happy. That's a nice problem to have. If it has a massive exit in 3.5 years, that's a good problem. So, but we also don't know the outcome at prospectively.
Right. Excellent. Let's see here. beyond the obvious commercial risk of investing in the stage companies that you do, are there any other risks that you see that are uh, troubling you for right side sourcing
Well,
sort of thing?
yeah, every on an so it's the differences between the risks at a individual company level versus the risks at a fund level of when you're diversified. So at an individual company level, there's a million risks. And frankly, any individual startup might have a very, very high potential expected return, but the reality is most startups fail for all sorts of reasons, operational reasons, tons of run out of capital. There's tons of reasons, tons of risks. It doesn't, lend itself to start listing them out, but most startups fail. Okay. But taken as a pool, that segment of the market as a whole has a very, very high natural return to it, because within that pool, although most fail, there's enough winners, and many of those winners are such big winners that the pool actually produces a really high natural return. So when you invest in the pool of companies, actually we're taking the risk level way down. And if you think of it like an index, our fund is not an index, but you can think of it sort of like a pseudo index. If you can buy an index fund in a market that produces really high returns, but you don't know which company is going to have be the big wins, well, you're going to sort of print money every time. Now, you can't do that in the public markets, but that's sort of what we're doing in this element of the private markets. And the challenge had always been, how are you going to do enough deals? That it's historically, for angel investors, that's had historically always been one of the big problems. How are you going to do enough deals to diversify yourself? It's hard to find deals. There's a ton of friction in doing a deal, executing a deal. It's expensive. All these problems that kept that's a risk premium in the market, that to incent dollars to go into this crazy risky market, because everyone's wildly under diversified. So that's what we're exploiting. You have this massive return at a asset class level because individuals can't get diversified enough for the most part.
So what's the just to recap your experience with the time to return for capital for the investors,
Yep.
and what do you predict in Fund 4?
Yep. So in general, the funds all have a similar profile, although it's gotten a little bit earlier over the years because of the capital efficiency. We're getting to companies a little bit later in their life cycle today than we were 8 years ago. Okay. But in general, we're investing the capital over a 3.5, 4-year period of time. Companies on average, they take 5 years, 6 years to get to a exit. So from a fund perspective, an investor should not expect to be getting anything meaningful back from the fund in distributions in the first 6 to 7 years, 6 years. And the bulk of the large distributions happen in those years 7 through 10. So the benefits are pretty obvious. We've been talking about them, that it's a way to get high returns, more consistent returns, protect the downside, avoid most taxes, things like that. The sacrifices are, one is it takes a while to play out. It's largely back-end weighted. It's long-term asset growth. It's not going to produce much in the way significant in the first handful of years, and it's illiquid. Those are the sacrifices getting into this kind of a fund. Not too dissimilar with any venture fund, but I'd like to be pretty blunt and transparent with that.
Yeah, totally makes sense. And thank you for being that way. So this has been really, really good. Thank you, as usual. Jeff, you did an exceptional job. And thank you, everybody, for being here. You want to wrap it up with a statement? And let me say before Jeff that we're going to make sure everybody on the call is going to be provided to Jeff, so he'll be in touch with you to follow up. And
Ye-
also, if there's others in your community, your network, and your friends that are interested, be sure to make that happen.
Great. Thanks, Arthur. Again, thanks for everyone, to everyone out there for participating. And yes, I will be following up with an email to people. You'll receive something so you can have the information I went over here today, the deck and so forth. Anybody that wants more detail, we're happy to provide additional information, have conversations, whatever it might be. So feel free to reach out.
Great. Thank you again, David Siegel, for the kind and proper introduction to Jeff. Thank you, Jeff, for an exceptional job again. And thank you all for being here. And as I always say, sharing the only thing you can't make more of, and that's your time with us. Thank you. Until next time.
Thank you very much. Bye-bye, everyone.